Hi, good afternoon. This is Ruth McCambridge from the Nonprofit Quarterly, and today we're going to be talking with Hilda Polanco of FMA. But before I introduce her, I want to I want to just make a few comments about the day and the weather, because it may actually have an effect on the forecast. As I'm sitting here, there's a huge storm going on outside, and where Hilda is, there's a huge storm going on outside, and not one of us is in the same location today. The tech people are all at their houses, and we're here. So this is just to warn you that if the weather does intervene, we'll try to get back on as quickly as possible. If I drop off, my colleague Joel Toner will fill in for me, but we're going to try to get through this and make it great as always. So I want to welcome you today to Maximizing Nonprofit Internal Controls, an essential guide for even the most pure. And that was actually my title because my experience has been that sometimes organizations, if they overlook internal controls, sometimes it's because they don't know what they need to know, but sometimes it's because they just trust each other. And that's a great thing, but it is not a control, and it's not something that even the smallest and most family-like of nonprofits can risk. In fact, just the opposite. So before I say anything else about the webinar, I do want to thank very much our sponsor. And our sponsor is the entity that allows us to present this to you free. We have at Nonprofit Quarterly, we're very intentional about our hope to bring most of what we produce to you free. And so AccuFund being willing to sponsor this session has made that possible. So AccuFund is a nonprofit financial management specialist helping thousands of nonprofits improve their overall financial management. Their reporting capabilities and intuitive dashboards enable sound decision-making and better strategic execution of your mission. AccuFund helps organizations streamline their processes and improve their efficiencies, right-sizing their costs. Their nonprofit financial solutions are a combination of services which they tailor precisely to your needs. We are going to be, we do provide about 15 to 20 minutes at the end of each session for you to ask your own questions to the presenter. And so if you want to ask a question, you should log it in the questions box at the lower right-hand side of your screen. I will go through those questions as Hilda is presenting, and then at the end I will ask the questions that she has not already answered, because very often she will ask questions that people answer. But you can log in your questions anytime during the webinar. The most asked question ever in any webinar is, will this webinar be recorded and can we get it? And the answer is yes. So you don't have to ask us that question. We're going to send it to you. If you're signed up for this webinar, we're going to send it to you right after the broadcast, and then later it will be available on our website. The other thing I do want to say is that we did have a LinkedIn discussion which we were going to use at the end of this broadcast, but given that it's a new technology for us and the weather, we decided to cancel that little experiment today, and we're going to go straight on what we already know. So now I'd like to introduce our wonderful presenter with whom we have done a number of other really remarkable webinars. You should go look for them if you haven't already watched them. Hilda Polanco has led Fiscal Management Associates to become a go-to capacity builder where foundation and nonprofit leaders seek to address financial management issues. She's a nationally recognized and sought-after leader in the field, and She serves the sector in many ways. She's a founding member of the selection committee of the New York Nonprofit Excellence Awards established by the New York Times and the Nonprofit Coordinating Committee. We're very excited to hear from her today. And with that, Hilda, I'm going to pass it over to you. And then I will come back in about, oh, one more thing. You can share information that we're sharing with you on Twitter. So look for the hashtag on your screen, and you can share it there. So I want to hand it over to you, Hilda. Hilda's going to talk to us today about how to institute organizational controls, organizational financial management controls that really guard your integrity, no matter what size you are. And so take it away, Hilda.
Thank you, Ruth, and welcome everyone. That hashtag was hashtag Hilda on Finance. And I have to start by saying that I started my career many, many years ago as an auditor with the firm of Ernst & Young, and so in me is the blood of that experience through the years. And when we selected this topic, I wanted to present it to you all from the perspective of internal controls within the business environment and what it means to think about that on an ongoing basis as leaders of your organizations. When you think of those words, internal controls, I think many of us have different words and concepts that flow through our mind, and I wanted to just kind of float a few past you, and as we go through our presentation this afternoon, I'm going to address some of those and really distinguish why they, in fact, all come to mind for us, but how specifically different they all are. And of course, the first set of ideas that come to us are these words called policies and procedures. And you will hear later that, in fact, the combination of policies and procedures create the environment of internal controls. So they're very, very important. You might think of fraud prevention. We want to have strong internal controls so that fraud is not as likely possible for an organization. We want to think about segregation of duties, and that is a very critical concept in the idea of internal controls. And segregation of duties means no one individual within the organization has the control over an entire cycle, and I'll share many stories with you about how important that is. Reconciliation processes. I want to mention one point, and that is that if you are ever in a conversation with a team member or with your board or at any other point, and it becomes apparent that the bank reconciliations for the organization are behind schedule, that should be an alarm that goes off for you, because reconciliation processes are key to making sure that the information you're receiving is as up to date and reliable as possible. It is also the process that often will detect when resources have been misappropriated in one way or another. So it's a really important process. And there are many others around revenue and online donations, and any reconciliation process is a check and balance. It helps keep things the way they should be. You might hear the term monitoring controls. There are two types of controls. Monitoring is one that identifies, it detects that something isn't right and that something may be at risk. Preventative controls are different. They're like the police standing on the corner. They're there to prevent something from happening before it actually does. So they're different, and you'll see how that plays out. And then lastly, this idea of fiduciary oversight. When we think of fiduciary, we think of our board of directors and what their role is. And oversight, of course, is their role in this area. You may see that nowhere on here do we have the word external audit. And as an outside audit firm coming in, that is a process that some of you go through depending on what state you're in and what requirements are, But your outside auditor coming in is not an internal control. As a matter of fact, fraud, as reported by the Institute of Fraud Examiners, the number one way that fraud is detected in an organization is by no way the outside auditor. It is, in fact, by an internal employee, often known as a whistleblower. So an internal employee identifying something doesn't feel right is the number one way that something is identified. And so we want to create that culture where if someone feels uncomfortable with something, they are going to feel confident that that can be shared with the right folks. You also don't see insurance up there. Insurance is something you purchase, and it helps mitigate damage should you face a misuse of funds situation. But insurance is not an internal control. It's something you purchase in addition to what you do internally. And one thing I will say as we're going through this, I will give you tips about what to keep in mind. And I do need to say that having said that insurance is not an internal control, I do encourage all organizations to speak to their insurance broker and learn about what's something called employee dishonesty coverage. And that insurance allows you to have a policy that would protect you so should something go wrong from misuse internally. That is something that every organization should be aware of and take a look and see. Not an internal control, but something to explore. There are three key areas that we believe are critical to successfully addressing these ideas that we're mentioning. And the first is culture. Culture is a word that we hear often, just right along with talent management and talent development. Culture is the key to who we are as an organization and what we believe is important and what we relate to our staff is important. So influencing a culture where internal controls is key is an important first step. The second step is having the clarity of policies and procedures that indicate what is important to the organization and what are those policies that have been set and how do they carry out. And lastly, there's this concept of leveraging technology. Oftentimes, internal controls are associated with lots of resources and lots of people to reconcile and complement each other. And segregation of duties, for example, we're often asked, how can I segregate duties when I have a staff of one in the finance office? And that could be challenging. But there are ways. There are ways to segregate by bringing in other members of the team to perform individual activities. By looking at technology as a partner in all of this, whether it's with your bank or with outside vendors, you are in fact addressing some of those segregation of duties problems because you are automating some of the work that you do, and think of it as like the business processes are hardwired in, and no one individual has the control over the entire process, which is what we said segregation of duties was. So leveraging technology is from a place of increasing internal controls, as well, of course, as increasing efficiency in the way that we do what we do. So I will share with you some ideas and some concepts in these three critical areas that we believe together create the strongest internal control environment for an organization. I will start with the influencing culture. And leadership can influence culture in a few ways. One is setting the tone at the top, the right tone. And if you've heard me talk about 990s in the past, I believe that the governance section of the Form 990 is where an organization really is reporting their tone. What kind of policies are in place? Are there whistleblower protection policies? Are there document destruction policies? Conflict of interest? All of these will come up through my presentation. but it is the leadership's ability to say, this is the tone that we believe is important for our organization, and we share that not only with our team internally, but externally as well. For example, we have seen instances where um, misappropriation of assets became apparent because an outside vendor said something. It just didn't feel right that certain assets were being delivered to a home in the suburbs somewhere, but they were under a purchase order for a school district. Those feelings that people have where it just doesn't feel right, the organization should have a way where people can communicate, and that tone is making it clear that we believe in this idea of transparency. The second part, the second way that leadership can influence is by creating this culture of what we call financial discipline, that we believe finance is important, we believe numbers are important, and we believe protecting the assets of the organization are important. And the third leg of that stool, all in a very complementary way, is promoting transparency within the organization. And these three come across in different ways. So what does this look like? In terms of setting the tone at the top, leadership needs to lead by example. For example, leadership is not exempt from receipts or from timely submission of expense reports or any other control activity. As a matter of fact, in the audit world, one of the key audit procedures that audit firms believe are important is to review the expense reports of the CEO. And if those expense reports are held to the highest standard of controls and documentation expectation, that is a sign that the organization is setting the right tone. With respect to the financial discipline culture, fiscal policies and procedures in that culture are living. They are a series of charts and workflows rather than heavy memos and sort of heavy book-looking documents. Results are monitored regularly. That means we have budgets, and leadership looks at a budget to actual analysis to see how we're doing. And in terms of the procedures, the staff are trained on all of the policies, and budgets are approved and monitored in a timely and effective way, not just by the staff, but by the board as well. Here again, when an outside audit firm comes in, and again, they're testing for what are some key controls, the minutes from the finance committee meetings and the board meetings, the discussion of variance analysis, the fact that the board is looking at a variance analysis and keeping an eye on actual results, that is an internal control. The board engagement over that. And if there was misuse of assets, it would come through in some of those actuals if payroll was higher than it should or travel expense just seems out of line with the budget. Those are all compensating activities that we do to get to this point of promoting transparency. And the transparency comes through in the actual evaluation of the information and the sharing. And then in policies like whistleblower protection. And the whistleblower policy indicates within an organization that if someone is uncomfortable with what they see, they should speak up and they will be protected. Conflict of interest, I believe, is also critical both at the board level and at the staff level. And I'll give you a few more examples. So we've created the tone, the culture, and the transparency within the organization. As far as this concept of policies and procedures, like who does what part, the policies are resolved by the board. Policies around approval levels, around signatories, around commitments for the organization, around payroll and salary, all of those are adopted by the board, and then the leadership of the organization actually spells out how are we going to ensure that those policies are adhered to. Together, that creates that system of internal controls. When we think about policies, there are many different policies that organizations can have, and we thought about, well, if we had to find 5 policies that we think are really critical, which ones are they? And I will say this is more policy areas than specific policies themselves. But the first one is around revenue and donor acknowledgement. And every organization that receives donations needs to have some sort of communication back to the organization saying thank you for your donation. In cases actually where I have seen um, funds intended for the organization that did not ultimately arrive as intended but were redirected in some inappropriate way, it was the thank you letter that they didn't get. It was the lack of acknowledgement that generated the inquiry, gee, I sent a donation and my check was cashed, but I never got my thank you letter. So that concept of revenue and donor acknowledgement is really important. And from a segregation of duties place, we always recommend that those responsible for updating the donor database and sending thank you letters should not be the same members of the team that are actually responsible for processing the actual donations as they are received. So we should not have one person control the receipt of the donation and the donor acknowledgement letters. A second policy is around approvals and credit card agreements. And years and years ago, we used to see quite a bit of frustration and risk around the area of petty cash. And I used to call petty cash the smallest item on the balance sheet and the biggest headache from all sorts of angles. Well, petty cash headaches have been replaced in our current operating environment with credit cards. And now it's not about the petty cash, it's about the credit card and the receipts and the documentation that's expected. And credit cards are in many ways a blank checkbook. Individuals have credit cards with them, and we live in a world where online purchasing is the way that business is conducted. So having policies around who is authorized to use the credit card, indicating limits on the use of the credit card, purchasing technology solutions around the credit card that will actually maximize, or I should say minimize the risk of who is using the credit card and for what amount. All of that approval process around the credit card is really critical. And keep in mind that a credit card given to an employee is an advance vehicle. And so a policy that we often see around the clarity on purpose is that if an individual for some reason was identified as using the credit card for personal use rather than business, that amount can be withheld from their final paycheck, and that is written into the policy and agreed to by the individual, by the employee. So we want the convenience of the credit card to come with the controls to protect the organization. Another area where policies need to be really clear is around payroll. We know that payroll is the largest expense for most nonprofits, and it's important, back to the segregation of duties, that no one individual is charged with the responsibility of adding employees and actually processing their payroll. As we recommend that donor database administration be separate from receipt of donations, we also believe that adding individuals to the payroll system, which usually is part of a human resource function, be separate and apart from processing payroll. That's why we believe that payroll as a function belongs more in the finance area than in the human resources area of an organization. And we always have interesting debates about that. So payroll and access to the payroll system and changing accounts for people who, in this world of direct deposit, all of that is a key place where segregation is important. I mentioned a fourth policy, or I mentioned this policy earlier, which is the conflict of interest and whistleblower policies. Those are referred to often as corporate policies, and they promote the transparency within the organization, and again, are very clear policies that everyone understands. In the case of the conflict of interest, I think it's equally as important that staff members of an organization sign these policies in addition to the board. I see often the board, but not as much the staff, and the staff are often in positions of selecting vendors. And one example that we saw happen here in our home city of New York City is if an organization leadership does not have sort of a fresh perspective around advisors. So any individual advisor, be a law firm, an insurance broker, any investment advisors, those relationships really do need to be kept fresh and absent of any conflict of interest. In the case of an insurance broker, it should be something that is reviewed periodically and always brings a fresh perspective to the organization. And so conflict, both staff and board, we need those policies. And lastly, cybersecurity is an area that it's a huge area. I wouldn't even know where to begin to articulate the most important aspects of it. I do want you to walk away with this idea that we live in a world where cybersecurity is outside of our control and in our everyday life. We begin by addressing it by creating awareness of what are some things that the staff and those who have access to your systems can do to try and protect us against these threats. There's a trade-off between security and efficiency, access to files, how individuals are trained to see what a suspicious email might look like. And often we hear, well, if you gather client data that is subject to HIPAA, you need to make sure you have the right security. If you have donor data from Social Security numbers and any private data from your donors or Social Securities for your staff, all of those are extremely critical, and of course you need to protect those. But we also see individual organizations' entire data, their database, their accounting system, be jeopardized or sometimes imploding because of a virus. And although the risk is different from the HIPAA or the donor data, it is in fact your entire data for your organization, which is extremely valuable as well. So protecting against viruses, knowing your emergency recovery systems if something were to happen, those are all absolutely critical and part of a technology plan. We absolutely believe that it is important for you to operate technology to its fullest in the safest environment possible, for sure. So you can see these are just 5 areas. There are many more depending on the type of organization you are. If you have large amounts of in-kind goods that come into your organization, you certainly want to have policies around the idea of those goods being protected. When I look at these policies, there's also one that's not listed here, but I want to also let it be a takeaway for you, and that is that in the nonprofit sector, there is this idea, as Ruth said at the beginning, that trust is not an internal control. And the concept of vacation is a critical control. If an individual in a finance function never takes vacation, there is never a time when a fresh set of eyes comes in to actually step into those duties, even if just for a few days or a week. And so we have seen way many cases where had someone just taken vacation for a 1-week period and someone else stepped in, the activities that were inappropriate and were not detected would have come to fruition or would have become evident. And so mandatory vacations, just another tidbit. And also what we see in a lot of these policies is that during periods of vacancy, someone's on maternity leave or there's a resignation of a position and you're trying to fill that vacancy, all of that period of time, that interim period, is a high-risk period. Organizations may have beautifully developed policies and segregation of duties, and then with the vacancy, everyone tries to help out, and during that period, risk increases. So we recommend highly that during a period of vacancy in areas of financial responsibility, that an organization take note of putting in place other staff doing certain duties. What are those proper segregation of duties points that cannot be jeopardized during the period of vacancy, so that the risk does not increase and all of the hard work that went into actually putting them into place is not lost. As far as the separation of payroll responsibilities, just one last point on that. It is during periods of termination, when someone is leaving the organization, that we often see people being held for a longer period than they were supposed to, and sort of risk areas happening during that period of transition where it's not the regularly scheduled payroll. So we hope that these 5 will give you some food for thought around what are the critical areas. As far as the last part, the leveraging technology, the examples of where technology can help cut across a few ways. One is software integration. The more that 2 software packages can integrate with each other and data travel seamlessly through the system, the lower the risk that something will be either inadvertently or intentionally adjusted. Secondly, technology allows business rules to be in place, where before technology we relied on humans to make decisions around certain things. The business rules are hardwired, so if expenditures over $5,000 require 2 signatures, and we are using an automated bill paying system, which I'll talk about a little bit more in my next slide, that will not happen without those 2 signatories. So the automation forces the business rules to be respected by the way that these things are designed in their workflow. Technology allows us to have restricted access. Only certain people with authorized access with passwords, and that brings back the cybersecurity framework that we need to have. We need to respect those passwords. Otherwise, the entire system is at risk. And then lastly, audit trails. By integrating software and integrating processes, the entire flow is available through the technology platform for review. And again, from a preventive control place, from only or allowing, ensuring that only those with limited access can actually get to these items. With respect to how we leverage technology, we believe that partnering with your bank is a key strategy. Your bank houses the cash that you receive, as well as manages the cash that goes out the door. And by manages, I mean it's the processing center. We don't have our cash in our drawers. We have it with our partner at our bank. And most of the leading banks these days have invested in pretty powerful technology platforms. And when you consider what bank you will want to do business with, there are many factors. I'm encouraging you to add today's conversation to one of the factors that you consider in selecting a bank. Has the bank invested in the technology that will help them be a better partner with you? Some examples are positive pay. That means a file goes to the bank, and only the checks that are listed in that file will be honored by the bank. So again, you're preventing checks that are not authorized by you from being processed by the bank. A more recent idea is the idea of reverse positive pay, which is only the checks that are approved by you as presented by the bank on a day-to-day basis will be processed by the bank. And that's a newer concept. But both relate to this idea that only what you have approved will the bank actually pay. ACH blocks and filters are ways for you to say to your bank, I will not allow a third party to come into my bank and debit my bank account. We have seen many, many cases in the earlier stages of online banking. I think organizations have smartened up to this, where just by having the routing number and account number of your bank, which obviously anyone would who's received a check from you in the past, the debit process can be created by a third party. So a third party says to Con Edison, debit this account for $1,000, and it's becoming harder, but still not impossible for someone to do that, and maybe without the best of intentions. So the bank would prevent any ACH debits from happening. Creating electronic funds transfers with your bank also improves controls in that payments are being made electronically rather than through the use of checks. And the danger with checks is when you have blank checks, the control over the blank checks. So many of our instances we've seen where organizations are in a difficult situation is because a blank check was appropriated and misused in one way or another, and the systems in place were not strong enough to detect that. So by using electronic funds, that reduces the chances of an inappropriate use of a check. Banks also have purchase cards, and I talked a little bit about credit cards before. Purchase cards are even more limiting in terms of risk, but they put cash in the hands of many more individuals than perhaps you would want to use with credit cards. Purchase cards can only be used at certain stores for certain dollar amounts with certain thresholds, but again, it increases the efficiency that staff in the field may need to have access to staples or to food vendors for programmatic activities. Petty cash being this not only risky and paperwork intensive, also requires you to go back to your office to get the petty cash. In a world where people are working virtually so much more, a purchase card gets funded and refunded as many times as needed, and the technology behind it will tell the supervisor who's using the purchase card at what stores for how much, and it's really allows a level of analysis that was never possible based on chasing receipts down in the credit card system. Online banking, I don't have it listed here, but it is the whole environment of access to the data on an online system, and I've got to believe that everyone on the call today is using some version of it. Something I didn't mention during the revenue conversation is this idea of remote deposit. And we focused here on the disbursement partnership with the bank. The remote deposit is a feature that is more on the cash receipt side. So rather than individuals having to walk to the bank and take the checks on a daily or weekly basis, remote deposit is scanning, much like we do personally on our iPhones these days. We take a picture of a check and it's deposited. At a business level with many checks coming in every day, remote deposit allows the check to be scanned into the banking technology. No one needs to leave their desk, and it can be routed in a way that, again, we have the right segregation. These are just a few of the controls that your bank has to offer. We encourage you to explore these when you're making that partnership decision. There are more and more products out there on automated bill paying, and some are through your bank, but many others aren't. We have seen products like Bill.com and others. American Express has a product also where the approvals are pre-established. It is a paperless environment. Invoices are scanned, and all is electronic after that. And there are no blank checks, which is what I mentioned earlier in terms of a risk reduction strategy. The automated bill paying, come audit time, all of the invoicing is available. You can do queries as to who we paid and how much. It really, in all of these examples, it's about increasing the transparency over the data and having access to the data in a much more instant way where something could be detected much more easily. As far as just some recap thoughts, and then we do have some time for questions. We want to hear what's on your mind, and I know Ruth has probably been organizing some of those questions already. I want you to walk away from today with these ideas. One, we want to influence culture. We want to create that tone of financial discipline, transparency. Remember, trust is not an internal control. Employee dishonesty insurance you purchase, but you first create a culture where that is just known not to be acceptable within the organization. You have policies and procedures that are set by the board and implemented and operationalized. They're easy to understand, they're easily accessible, they're on the shared drive, they are as automated as possible. You're making it easier for individuals to follow the policies, not harder. You're thinking of ways to train staff when they join. Every individual who is in the organization interacts with dollars in some way, even if it's just their own expense report. Every individual understands what's expected. And on the technology side, from automation to banking, we are increasing both controls and efficiency by thinking of technology as a partner with the organization in all ways. So I am going to come back to Ruth now for those questions, and look forward to answering those.
Perfect. Thank you, Hilda. Boy, that was a lot of information in a short period. And so for those of you who did send me the question anyway, is this going to be available afterwards? Yes, indeed it will be, and we're going to send it right to you. So there's a lot of great questions here. I'm going to ask you one that I hear a lot, which is they're asking the question about rotating external advisors in the area of finance. So that would include, I imagine, auditors and accountants. How do you feel about the need to rotate those, and in what kind of time period? What are your feelings on that?
Okay, so auditors operate under the concept of independence. An auditor needs to be independent from the organization, and it's this idea of how long is an organization's relationship with an auditor independent? Is it 2 years? Is it 15? Is it 20? Where's the magic spot? And it's hard to come up with a number. I like to follow the federal guidelines around significant advisory services. And at the federal level, the OMB policies say that you should reevaluate these relationships every 5 years. It doesn't say you should rotate or change. It says reevaluate. And so what that means is, are we still the right size client for this audit firm? Are they still the right size for us? There's mergers on both sides, and so sometimes there's a mismatch after that. Some firms who work with publicly held entities at the publicly held level, you do have to have a partner rotation every 5 years. So some firms will rotate partners every 5 years with all clients, nonprofits included. And if a firm is large enough, that's simple enough to do. Again, it's not that you need to change. You may be totally happy with the match the first 5 years, the second 5 years, and then after that 10-year period, you just want to keep that relationship as fresh as possible, so you may want to consider it again. You mentioned, Ruth, auditors and accountants, and accountants sometimes are advisors, more as I call us outside insiders, where we're helping an organization over time. That relationship does not operate under the rules of independence. As a matter of fact, the more they know about the organization, the more helpful they can be. But it is also, again, a good, healthy question. Is this still the best match for the organization?
That's great. And here's another very, very frequently asked question, even in this particular session, which is, what if you only have one staff person? So how do you then handle the separation of duties idea? And this was asked probably 5 times
So if I
in
have,
relationship to things like payroll and donations and you name it. People asked it. What do
mhm.
you do if you're very small or have only one staff person?
So in that case, you want to look at the flow of information from entering the organization to its ultimate accounting. So let's take payroll. If there's only one person in finance, that function that I described of adding people to human resources, that should be someone that's not the one person in finance. Maybe the executive director needs to get involved in being the only individual who can approve adding a staff. And in a small organization, I feel like that seems like a reasonable request. In the case of the cash disbursements, right, the one person is writing the checks or requiring the payments. How do we segregate that? I myself was a treasurer for a very small organization. I became the person who would do the bank reconciliation at the end of the month. Not something that I highly recommend that treasurers get into the accounting at the organization, but in a really, really small organization, you want someone outside of that individual doing the reconciliation. Or another option is the reconciliation is done by this person, but all material related to it is reviewed and detailed by the treasurer. So a new set of eyes upon the activity that is happening. I have known executive directors to every Friday morning scan the online banking activity for the week. Not a lot of activity. The individual signatory is the executive director, can quickly spot something that would be unexpected. When we used to receive unopened bank statements from the bank, I would always recommend that the executive director be the one who received the bank statement and opened that bank statement and took a look at what was in there. Amazing things would be found in cases where something was inappropriate. We don't live in that world any longer, so access to online banking on a periodic basis where the staff knows that the executive director is doing that or the treasurer is doing that, those are all compensating controls that you can have in place. So I can come up with many more examples, but the idea is more than one set of eyes is looking at the activity in an surprise basis or unanticipated basis, so that at all times this one complete cycle is not possible with just one person. And for the benefit of that one person who might be the one on the phone call today, you want to create that because you don't want to be the one individual that everyone would look to if something went wrong. You want to protect yourself in that situation as well.
We have a question that's related to that in this line of questions, which is, how do you begin to talk about controls as a benefit to employees rather than as a protection for the nonprofit?
Well, I think in this particular example that I just gave, controls are there to protect the organization, but also the individuals against sort of unfair accusations just because it appears like something could be a certain way. And so when the controls are in place to make sure that approvals need to be at the right level, someone can rely on that and feel like they would not be inappropriately accused of something. And so I see that as one benefit. The other benefit is that the controls ensure that the assets are being used as intended in the most appropriate way for the organization. And so if you live in and work in an organization with good internal controls, you know that the resources are going to where they should be going. And that means that the organization has a lower risk of loss, which means the organization has a greater possibility of delivering on its mission. So that healthy internal control system protects individuals in that they now know that they're working for an organization who has a higher likelihood of delivering on its mission, rather than seeing clients not receive the services that they were that they deserved or that they had intended for, because assets are redirected to another purpose.
Great. And I'm going back, I'm sorry, but this is such a big number of the questions to the small organization. Do you ever allow the ED to write and sign the checks? Both write and sign them?
I think if there was no bookkeeper, such a small organization that the ED was and again, writing checks these days may not mean literally writing a check. It may mean going into the accounting system and issuing them. I don't believe it's a good system that the person has the ability to issue the checks and is the authorized signatory. I think there are ways to bring in an administrative support person. There are ways to even bring in board members as the authorized signatory. There are many different ways. There could be, from a preventive control, that's what I would recommend, the answer be no. From a sort of detective control, if you decided as an organization that that is the way you're going to go, then on a monthly basis, the board treasurer should be reviewing the activity in the bank account, the canceled checks that now come through that, sort of the picture of the check. Somehow another set of eyes has to be present. And the executive directors are human beings like all others, and I have seen as many bad situations happen at that level as I've seen inside the finance office. So we want controls at all levels, including the ED.
So another question kind of related to this. First of all, there's one person who's asking, what do we do now that the copies of the checks are so tiny that we can't read them?
I think that's an excellent point. And what I do is I zoom. Most packages allow you to zoom on the picture. And the person who's asking that question probably remembers when canceled checks, you always looked on the back to see
right.
if it made sense, if it was the right vendor. You can still do that. It's a little bit harder, and zooming, I think, is the answer there.
Another question that was asked a number of times, which is, are there any rules about when you need double signatures and when you need a board signature? Are there any rules for that? How do people make those determinations?
That's a really great framework question. There is no rule like it has to be 5,000 or 10,000 or 1,000. There's no absolute right number. What we believe is the right approach is to identify a number that, based on your business model and your volume of transactions, it's a natural cutoff where significant items would be identified. And so what we recommend is that an organization review its disbursements ledger for the last 6 months, say, and sort those disbursements by dollar amount from highest to lowest. And you will see a natural break that it will become evident that disbursements over this dollar amount are really more significant ones. And under that are just volumes and volumes. Organizations that want to be conservative will sometimes have a very low threshold for dual signature. And in some ways, they're invalidating the whole process, because if I have 150 checks to sign or online authorizations to give, there's probably still the same amount of time I have available to do it in. So if I now have to look at 150 items instead of 50, I'm going to spend less time. And so we want this to be a reasonable amount of transactions for that second signatory to be required. The dollar amount, as I said, is that natural threshold or that natural cutoff. You could also manage the volume by saying, do we have specific payments in the year that on a monthly basis are the same amount, like rent or medical insurance or some of the other insurance policies or equipment contracts, that they're the same amount every month. So let's get that group, and that group is approved at the beginning of the year and doesn't have to add to the pile on a monthly basis. So that's another way that organizations identify significant items, put them aside, and have them approved at the beginning. As far as board approvals, the board signature usually comes into play as the second signatory when there aren't enough leaders in the organization who understand enough about the business to be appropriately authorizing a purchase or signing a check. If there is no one other than that one other supervisor, like the executive director, then you don't want to bring in someone just for the sake of bringing them in if they don't have the wherewithal and knowledge to really approve. That's when you go outside the organization for a board approval. The idea of automated bill paying has made board approval even that's much more doable. In the days when you would have to travel to the board member's office to get their signatory and they're traveling, they're really busy folks, the whole system kind of comes to a halt, and then there's a tendency to not adhere. So the ideal number where the amounts are reasonable, where is that natural cutoff? And again, board comes in only when there is no other individual with the knowledge in-house. I would also say that I have seen dual signatory of a certain dollar amount, and if it should exceed X, a very, very high number, then the second signatory must be a board member. But these are all steps you put in place to identify significant items that would need attention by the right people.
Right. I have a classic one to end with, Hilda, which is this person is wondering about the value of an external audit for a very small organization. We have never done one, concerned about the overall cost benefit.
So I love those questions because they bring you back to who decides when an audit is required anyway, right? So it's at the Department of Charities level for every state. In New York, it's been $500,000 for years, and now going up, it's $250,000 for years, just went up to $500,000 a year, and will be going up to $750,000 in the short term. In the state of California, where we do business in a big way, the Department of Charity says an audit is required at $2 million. And so there are states like Texas and Florida, Florida's changing actually, where no audit is required. So the audit requirement is really something that's arbitrarily determined by an attorney general's office in each state. And it really should be something, I believe, comes back to the board. And when does the board feel like it's appropriate to have an audit? I believe it's a good process. It's a good set of eyes. It's a reassurance to the board that someone with expertise is coming in and taking a look at the systems. That dollar amount is really up to the board to determine. 250 in New York has been low for some time, but it's really a board decision on that level.
Well, thank you very much. We are right at time, Hilda, and we got through this without a blip. So knock on wood, our powers will stay on in every way. And I want to thank everybody for coming. Remember that Hilda works at Fiscal Management Associates, and that this webinar was brought to you by AccuFund. Both are incredibly valuable resources for you in really shoring up your financial management models. I do want to thank you very much, Hilda, for being so generous with your time and knowledge, and encourage people to share this around. If you felt like this was very valuable and you know a lot of other small nonprofits or even one that struggles with the same kinds of issues, make sure you let them know about this, and that you let any networks know about it so that they can that this actually can become more of a resource to the field in general. So thank you, Hilda.
Thank you, Ruth. My pleasure, and I hope everyone stays safe in this fun weather.
Okay, see you later.